Okay, everyone, welcome to the first teaching in liquidity trading mentorship. In this mentorship, you will be receiving several sections and several topics with each with a longer video section. And that longer video section usually will be around half an hour, 1 hour explanation of the current topics we will cover. And aside the longer video section, the 30-minute, 1 hour video section, you will be receiving several much shorter videos which will only cover a couple of examples and short examples of how to implement the techniques discussed in the longer teaching on the real chart. Now, in this first teaching, I would like to discuss the basic elements to a trade setup in price action. Now, there are four basic elements in price action: consolidation, expansion, retracement, and reversal. Now, any time is one of these fours in the market that will occur. It just all comes down which one will occur at which time and which specific time of the day in the market. Now, usually the market starts off with a consolidation, so that would be the first element in the price action. So the market usually starts with the consolidation, follows with an expansion, the retracement. So after the expansion, we usually see a retracement and the reversal. Now, I also wrote here next consolidation, expansion, retracement, and reversal, the Asia range, London, New York, and Asian Open. Now, later I will be discussing what these mean. So I will explain all of them, but you may assume already yourself that all of these elements in price action, they are tied to a specific time of the day. Like, let's say the consolidation would most of the time occur in the market in the Asia range. So usually in the Asia range we see the market consolidating. So that would be the consolidation in the market. Now, after the Asia range, we have the London Open, and that's why we have next to the expansion the London Open, as it's mostly related to the London Open time of the day, the expansion. So after the consolidation, we always see an expansion. So it's always coming in this order. After the expansion, we have two possibilities. So in this case, it will not be 3 and 4, so the retracement and reversal. Sometimes it's flipped around, so it would be 4 and then 3, so the reversal first, and after the reversal we might not see the retracement. We just see the reversal. So after the expansion we see the reversal that might go back to the consolidation later in the market. So it's always the market opens, let's say in the Asia range with a consolidation, creates the expansion usually in London Open. If we see a continuation in the trend direction, the expansion is followed by the retracement. So consolidation, expansion, retracement, and after the retracement we see another expansion usually. So it will go back to the expansion phase in the market, and end of the day usually again back to the consolidation. So it's moving around this, but it will never be expansion and back to the consolidation, or consolidation or retracement and back to the consolidation. It will always be the market starting off with a consolidation, and then the market is creating an expansion. Or it can also create a consolidation in the market, the expansion, and after the expansion we might see a reversal in the market. So these are the basic elements of price action. Now, what is the consolidation? The consolidation in the market is a range that's moving within a clean trading range, and inside that clean trading range we will see the market multiple times crossing the equilibrium price level within the consolidation. So here on the right, in this example, on the right side, we see a very clean range in the market within this box. And within this box, we see the market basically moving back and forth the equilibrium line, the midpoint of the consolidation. And it does not show any sign of moving higher or lower outside of the consolidation area. And what does the consolidation mean in the market? Usually the consolidation in the market means that below and above the consolidation we have stop orders, we have stop losses, sell stops and buy stops. So above the consolidation we will have buy stops in the market. So what does buy stops mean? Buy stops are buying interest above a certain price in the market. So let's say we have the market consolidating around the equilibrium, and some people will have buying interest above the consolidation. So as the market breaks out of the consolidation range, they have buying interest, and the buy stop order would be opened as the market approaches a higher price level of the previous price level that was lower compared to the buy stop. And the sell stop orders would be selling interest below the consolidation. So if the market would break below the consolidation and create a breakout to the downside, it will be taking out sell stops in the market. So above and below we have stop orders. And usually when the market is consolidating, all it's doing is building up the buy and the sell stops above and below of the consolidation that will be later manipulated and triggered and so-called taken out. So the buy stops and sell stops will be mitigated by the expansion that will also be called the manipulation of the consolidation. Now, what is an expansion? The expansion is when the price moves quickly from a consolidation in the market. So on the right side, in this illustration, we will see this blue box. It's fair to say it's a small consolidation in the market, and the market breaks out of this consolidation, and that will be called the expansion. So right here we will see a consolidation in the market and the breakout of that consolidation would be the expansion. So right here we see the expansion out of the consolidation. Now, what happens usually when we see an expansion in the market? Usually when we see an expansion in the market, we see usually a retracement back to the area where the market originally broke out and expanded from. So let's say, for example, we have this consolidation area in the market, and notice that the equilibrium price point is nearly aligning with an order block candle. Now, what is an order block? Now, the order block is a candle, usually the last two down close candles before the expansion out of the consolidation. So let's say we see the consolidation breaking out of this, we see the expansion breaking out of this consolidation, and if we take a look at the equilibrium price point of the consolidation, we see the last two down close candles before the market expanded above. Now this will be the order block candle. Now usually this order block candle is giving us a good entry opportunity in the retracement. So right here in the green circle we will see that the market created the retracement after the expansion. So again it's following the order of first the consolidation. After the consolidation we see an expansion, and after the expansion usually we will, if the market is in a continuation, so if we would see a continuation for the expansion, first we see a retracement back to an order block in this example, and after the retracement and the retracement back to the order block, and usually also the equilibrium price point of the consolidation, we see another expansion in the market. So right here we see the market first expanded from the consolidation, it created the retracement, and the retracement came back to the equilibrium price point of the original consolidation in the market that was occurring before the expansion. Now the retracement here came back to the last two down close candles before the expansion, and that will give us entry opportunities. After the retracement we see another larger expansion, in this case as it was a continuation in the price. Now, what usually makes a retracement in the market? Now, retracements can usually be expected in a market when there is a fair value gap or a liquidity void in the price. Now, what is a fair value gap and what is a liquidity void? The fair value gaps and liquidity voids, they are price levels that are moving suddenly and rapidly from a certain price level. Now, they usually tend to be large and cover a lot of ground, and they will get filled. They will get so the liquidity voids and the fair value gaps usually they usually create a pullback, so they can fill the gap in the price. Now here on this example we will see a fair value gap in the market, and you can notice that in this purple shaded area on the top level of the purple shaded area we see the last week of a bullish candle. Now after that we see a very strong large move in the market. That's a rapid large move from one price point to another. And what we will notice that the market will create a retracement and a pullback into the previously created fair value gap in the market. Now this section, this large move in the market that covered a lot of ground and moved to one price to another price very rapidly. Now this can also be called, this area right here, this is a liquidity void. Now again, the liquidity void is a price action that will be filled back after the market continuing to the original direction. So here we see in this example with the fair value gap, the market created a strong rapid downside move that covered a lot of ground. It has a big candle that's moving very rapidly from one price to another price, and after the market would continue further down, we see the retracement back into this area. So why is this so significant? The reason why this is very significant, and later on in upcoming teachings it will be very important, as when we see a fair value gap like this, we can expect most likely the market to retrace back to that area. Now, let's say if you are in this case in the market, you will be looking for a continuation trade, or you have a bias of the market moving further down after the retracement and filling in the fair value gap. Now, this will be added to our trading plan, as it will help us anticipate when and where will the retracement happen in the market. Now, the reason why the fair value gap will be also very significant tool and technique later in our trading plan, as usually the fair value gap levels after creating a retracement, they tend to give a reaction in the market. So this will also give us good entry opportunities. Let's say in another example, if you will be buying somewhere around here on the bottom, and you will be a buyer from this level, you can use the fair value gap as a possible level where the market will rally up to, and you will be able to use this as target levels, let's say in a bullish trade in this example. Now you have also seen me draw these horizontal trend lines on the fair value gap on two specific wicks. Now the level you will be marking up on a fair value gap will be exactly these two wicks. So if you take a look at the market, we see this strong rapid move in price from one price level to another. Now I have selected this bottom wick as the top of the fair value gap, and from this impulsive move, this strong rapid move in the market, I have selected this first wick that's standing right here, and you will mark up the top level of this and the bottom level of this, and this section and this area will be considered as the fair value gap that you are expecting the market to retrace back to, or create a possible continuation after the retracement back to the fair value gap. And again, the reason why the fair value gap will be quite significant in later in our trading plan, as when we have a fair value gap in the market, we can anticipate the market to fill in those gaps. Now again, these will be used as possible target levels. So we might expect the market to fill in a price gap, and if we anticipate and expect the market to move to a certain level, and it will help us to know where the market is trying to go, then this can be used as our bias of where the market will be going in the future. Now, let's talk about the reversals and liquidity pools. Now, what is a reversal? A reversal is when price moves to an opposite direction, then it has currently went to. So let's say we have a bullish market and the market is creating a reversal, then from the bullish market we will see a reversal and the price direction to reverse to a bearish market. But now what's the importance in a reversal? Now when price reverses direction, it indicates that the market makers have ran a level of stops and a significant move should unfold in the new direction. Now what does that mean? Now usually when the market is running to a level of stop losses or liquidity pools, it will significantly change rapidly direction to the other direction. Now what does liquidity pools mean? Now usually liquidity pools can be seen as old highs or old lows, or we can even see equal lows and equal highs. Now you might be asking, what is the equal low and the equal high? Now the equal low and equal high, they are a typical retail trader pattern. Now let's say, for example, if we have equal highs, the retail trader mindset traders, they might see that as a possible double top, but we know that double top patterns, they will be indicating for retail traders to take short positions as they see a double top, as they believe a double top, or let's say a triple top, or equal tops, or relatively equal level tops or lows in price. Now retail traders will see that as potential support levels in the market, and when the market next time trades back into those levels, those retail traders will most likely take another trade into the opposite direction as their retail pattern is telling them. Now we are educated about this, so we will avoid taking trades if we have near an equal low or equal high price level, or we can also use equal lows and equal highs as possible target levels in the market. Now equal lows and equal highs can also indicate us where the market is trying to go. Now what does that mean? Let's say, for example, if the market is creating a retracement to an order block, and at the left side of the order block, at the higher price level, we see relatively equal highs. We can use the equal highs as forming our bias and confirmations that the trade will eventually take out the equal highs, as above the equal highs we have liquidity in the market. Now that means we have most likely buy stops sitting above those equal highs. Now notice here at all levels when the market is making a trend reversal, what it does, it's always targeting old highs or old lows in the market. Notice that old highs and old lows have buy stops and sell stops above and below them. Now the market seeks this liquidity, and you will notice as soon as it trades above or below an old high or low, it will create a trend reversal. Now the reason why it reverses the trend after sweeping an old low or old high is that the market is seeking the liquidity from the old lows and old highs, as there are traders who have their stop orders right at the high or the low in the price. Now on this chart we will see the relatively equal lows and equal, or we can even call it retail support, as the retail-minded traders will see these levels as support. You can see how many times the market have touched the same blue line. It has almost touched it 4 times, and most retail traders using classic support and resistance in the market will see this as a potential support level in the market. Now what does that mean? When the market trades back to it, again, as I mentioned previously, they will trade into the buy side of the market. Now here you can see that if we notice that the market has equal lows in this example, we can use this as a possible target for our trade, or also we can use this as a tool that will give us the bias in the market where the price is trying to go. Now what I mean by that is, let's say we have a pattern according to our trading plan giving a good entry somewhere around this level. And by the way, this level you will learn in later teachings that for our trading plan this could have been a good short position. Now if we have taken this short from this level and we notice these equal lows in the market, I mean, just take a look at it, how clean these equal lows are. They are exactly at the same price level. And back to the short. So if we take the short from this level, we can anticipate the market to trade below these equal lows, as the market has sell stops sitting below these levels. Now that was the first teaching. This was the first introduction and the just very basic elements in price action we will be studying in further future lessons. Now what have we learned today? We have learned that the market always starts with a consolidation in Asian range. Now the Asian range and the consolidation starting the market will be discussed and taught in future lessons a lot, as it can be implemented in a technique so-called daily cycle. And the London Open starts the expansion in price for the day. Now that means if Asian range is creating a consolidation in the market, we will see an expansion in London Open as the day starts. Expansion can be followed by a retracement or a reversal, or an expansion can create a consolidation again in the market. So an expansion again is followed by a retracement, reversal, or reconsolidation. Order blocks are typically found at the equilibrium price level of the consolidation. This means when a market is creating a consolidation and the consolidation is broken with an expansion, we may see a retracement back to the original level of the equilibrium price point of the consolidation. Now the equilibrium price point and the equilibrium price levels in the consolidation, now that's where usually we can find order blocks in the market. And order blocks can give us entry opportunities that the market will rapidly react from and expand again after the retracement if we are in a continuation market.